Hey everybody, Courtney Smith here with our February the 15th, 2021 edition of Wall Street Winners. Been a long time since I first started doing this. It was back in 1995, and we crushed it. I mean, we just totally wasted everybody in the market for year after year after year, and then I retired. And now I'm doing it back again for you for the last quite a few years. Okay, market holidays, President's Day on Monday, so everything is closed. And that closes everything too. Okay, so we've broken to new all-time highs. You can see Purple Predictor is pretty much neutral here. Notice how volume is declining here on the S&P in the lower right-hand corner. Dow Jones moving higher to a new all-time high. And you can see that, as I told you a couple of weeks ago, selling pressure is unsustainable at that level. Now we're up near highs, but buying pressure can continue to move higher. But still, this is a weak bull market. NASDAQ skyrocketing, Purple Predictor, moving to new all-time highs here on heavy volume. Looks pretty good over here. NASDAQ looks like the best of the three biggies. Now, seasonality, we're still on a bull signal. Remember, we got to get around to April, May, June before we could possibly switch. We could go back to neutral if we break that horizontal red line, but I don't expect that at all. Right now, utilities should be bullish neutral should be neutral until we get to May. Our one-year seasonal. So right now, it's pretty negative here until the beginning of March. So we've got about 2 weeks of defensiveness. The best scenario is all years. That's the top one here in our box. And it just shows a mild dip, no big deal. But the two that are most applicable are first year of a Democratic president and post-election year after the incumbent party loses. And those are the two worst ones, unfortunately. So we got to keep an eye on this. So far, the market's bucked the seasonality, and that's a good thing. Okay, asset allocation breaks to new highs. We saw almost $40 billion come out of the bond market and into stocks, and then a ton of cash, probably another 30 or 40 billion in cash came into the stock market. So there's a tremendous amount of buying that's supporting this marketplace. Fundamentals are okay. Monetary policy insanely bullish. And cash is coming into the stock market because cash is trash. Bonds not much better. I mean, 2% for 30 years? Give me a break. Stock market risk indicator also climbed higher. At some point, you don't want the risk indicator to be high. You want it to be moving higher because that means that people are reaching for more risk. In other words, they'd rather be in the stock market rather than in bonds and cash. Risk indicator also tells us that they want to be in sexy stocks like technology stocks rather than boring old stocks which don't go anywhere. So usually that's associated with a bull market. The question is when does it get too frothy? When does it get too bubbly? We don't want a bubblicious market. We want a bull market, not bubblicious. And unfortunately, we're starting to see signs of a bubble. Global shares finally broke to a new high. Not too interested over here, actually. Look at the RSI, the green line there in the middle. It is not making anywhere close to a new high. So don't look for these global shares to move much higher. Yield curve continues to move in a positive direction. The market believes that the economy is getting better, and the Fed has stopped manipulating it and is letting it go. Now, they are still buying tremendous numbers of bonds, and that's keeping the yield curve down. If it wasn't for the Fed, I think we'd be at 2.0, which would be wildly bullish for the stock market and wildly bullish for the economy. Bonds, how long have I been telling you to be short? Oh, that's right, months and months I've been telling you to stay short. They are going to zero. Okay, maybe not zero, but 130. Bond key factors remain bullish. Gold's the only one that's negative, and it's in its own world right now. Well, we'll talk about that later. But all my other key indicators are suggesting higher interest rates. The dollar, chop, we're at the same price we were back in the middle of December. So after the moves, we're really back to where we started from. So No big opinion here. Gold took a dive again. It rallies and then it gets smacked down, and it really has a hard time making higher highs. It's not a bear market. It's not a bull market. It's a kind of time to do something else. Put our money someplace else. Don't be long gold. Our gold key indicators are pretty neutrally. Commodity prices, which is the middle panel, that's bullish, but the other two factors are not, which are the euro and the yen. Crude oil, what a day on Friday. Explodes to the upside. This is a key reversal day. That's what that's called, where it makes a outside day and a reversal bar, all in one bar. Very, very powerful. Looks like crude oil is going to go higher than I thought it would. We're already up to $60. Strong demand and tight supply. Bitcoin broke out, as we mentioned last week, and we have to remain somewhat bullish here on Bitcoin. The purple predictor is bullish. We're in a bull market. We broke above the 55 days highs. I think you got to be long right now. All right, freebies, we will talk at you later. Fully paid up members, hang on 1 second.